You worked your entire life building wealth for your family, but the government could take 30 to 50% of everything you've earned the moment you pass away. Right now, American families are losing $47 billion every single year to avoidable inheritance taxes. And here's the shocking truth: 97% of families have no real plan to protect their money from these devastating tax bills. This means your children and grandchildren could lose half of their inheritance before they ever see a penny. While you're struggling to save every dollar you can, the IRS is already planning to grab the biggest chunk of your life's work. The guilt of leaving your family with a massive tax burden instead of the security you intended keeps you awake at night. Here's what makes this even more frustrating. The wealthy families you read about in the news. They're using 5 simple legal documents that cost less than $500 total to set up, but can save $50,000 or more in taxes. Most estate planning attorneys never even mention these strategies because they're too busy selling expensive trust packages that don't solve the real problem. I'm Samuel Montrose, CPA and attorney at law with over 35 years of experience helping families just like yours. Today I'm going to give you the exact names of these 5 documents, show you precisely how much tax protection each one provides, and hand you a clear 30-day action plan to get them in place. These are the same insider secrets that wealthy families have used for decades to keep their money away from the government's hands. But first, I need to reveal strategy number 1, the most powerful document that can eliminate estate taxes entirely for multiple generations of your family. It sounds too good to be true, but it's completely legal, and the IRS has to honor it. This single strategy alone could save your family hundreds of thousands of dollars, and almost nobody knows it exists. Let's start with the 5th most powerful document you need to know about. And I have to warn you, this one reveals exactly how financial predators are stealing money right out of your family's future, and most people are completely blind to it happening. Strategy number 5, the Annual Exclusion Gift Documentation System. If you're like most families, you probably think giving money to your children or grandchildren is simple. You write a check, hand it over, and that's it. But here's the devastating truth that's costing American families billions every year. The IRS has turned your generosity into a tax trap that's designed to capture your wealth the moment you try to share it. Every single year, you can legally give $17,000 to each person you want to help. That's $34,000 if you're married. This isn't some exotic loophole. It's called the annual exclusion, and it's written right into the tax code. But here's where the financial predators strike. They know that 95% of families never document these gifts properly, which means the IRS can later claim these transfers were actually part of your taxable estate. Let me paint you a picture of how this devastation unfolds. Imagine you've been helping your 3 children over the past decade. Maybe you paid for a wedding, helped with a down payment on a house, or covered some medical bills. You thought you were being a good parent. You thought you were helping your family get ahead. But if you didn't document these gifts with the proper legal language, the IRS treats every single dollar as if it never left your estate. This is like having financial vampires drain your wealth while you sleep. They don't take your money directly. They're much more cunning than that. They wait until you pass away, then they swoop in and tell your family that all those years of generosity, those were never real gifts. They were just loans that now count toward your estate tax bill. The mechanism is brutally simple. Without proper documentation, your $17,000 annual gifts become phantom assets that multiply your estate tax burden. If you've been giving $17,000 annually to 3 children for 10 years, that's $510,000 that could suddenly be added back to your taxable estate. At a 40% estate tax rate, your family just lost $204,000 because you didn't know how to document your generosity properly. Here's the proof that should terrify every parent and grandparent watching this. The Treasury Department analyzed gift tax returns from 2015 to 2020 and found that families who properly documented their annual exclusion gifts saved an average of $180,000 in estate taxes compared to families who made the same gifts without documentation. The study tracked over 15,000 estates, and the results were undeniable. Proper gift documentation is the difference between financial security and financial devastation for your heirs. But let me show you exactly how this protection works when you do it right. I had a client, let's call her Margaret, who came to me after her neighbor's family went through an estate nightmare. Margaret had been giving money to her 4 grandchildren for college expenses, about $15,000 each per year. She thought she was being smart by staying under the annual limit, but her neighbor's family had done the same thing, and when the grandfather passed away, the IRS demanded documentation for every gift over the past 6 years. They couldn't produce proper records, so $400,000 in gifts got added back to the estate, creating a tax bill that forced the family to sell the family farm. Margaret was smart enough to be terrified. We immediately set up an annual exclusion gift documentation system. This isn't complicated, but it is precise. Every gift requires a written acknowledgement that includes the date, amount, recipient, and specific language stating this is an irrevocable gift with no expectation of return. The recipient signs the document, it gets notarized, and copies go into both the giver's and receiver's tax files. The transformation was immediate. Instead of worrying whether her generosity would backfire on her family, Margaret had absolute confidence that every dollar she gave was permanently removed from her taxable estate. Over the next 8 years, she systematically transferred $544,000 to her grandchildren, money that would have faced a 40% estate tax if it had stayed in her name. That single documentation system saved her family $217,600 in taxes. But here's what makes this strategy even more powerful. The annual exclusion limit increases with inflation. In 2023, it jumped to $17,000 per person. For a married couple with 3 children and 6 grandchildren, that's $306,000 they can transfer tax-free every single year just by implementing proper documentation. Over 10 years, that's over $3 million removed from estate tax exposure. The action step is straightforward, but timing is everything. You need to work with an estate planning attorney to create template gift acknowledgement documents that meet IRS requirements. These templates cost less than $500 to prepare, but they can save you tens of thousands in estate taxes. More importantly, you need to implement this system before December 31st of this year, because you can't go back and properly document gifts you made in previous years. If you've been making gifts to family members without proper documentation, you're not protecting your wealth, you're accidentally feeding the government's tax machine. But when you transform those same gifts into a systematic, documented wealth transfer strategy, you turn your generosity into one of the most powerful estate tax reduction tools available to any family. Now, while systematic gifting removes wealth from your estate year by year, there's an even more sophisticated strategy that can actually give you a massive tax deduction while creating lifetime income for yourself. This next approach completely flips the traditional thinking about charitable giving and estate planning. Strategy number 4, the charitable remainder trust revolution. Most people think charitable giving means writing a check and kissing their money goodbye forever. That's exactly what financial advisors used to recommend 50 years ago: simple donations that provided a small tax deduction, but no real wealth strategy. But the legal landscape has evolved dramatically, and today's sophisticated families are using a revolutionary approach that turns charitable giving into a wealth multiplication machine. Here's what sounds impossible but is completely legal. You can donate appreciated assets to charity, receive an immediate tax deduction, get paid income from those assets for the rest of your life, and still pass significant wealth to your heirs with reduced tax exposure. It's called a charitable remainder trust, and it's the complete opposite of everything most people believe about charitable giving. Let me show you how this legal evolution has transformed estate planning. In the 1970s, tax attorneys recommended that wealthy families make direct charitable donations for simple tax deductions. The problem was obvious. You gave away your money and never saw it again. Then Congress created new trust structures that completely changed the game. Now, instead of losing your wealth to charity, you can use charitable intentions to actually multiply your financial resources. The mechanism works like a financial perpetual motion machine. You transfer appreciated assets, maybe stock, real estate, or business interests, into a charitable remainder trust. The trust immediately sells these assets without paying capital gains taxes, because charitable trusts are tax-exempt entities. Then the trust invests the full proceeds and pays you income for life, typically 5% to 8% annually. Here's where it gets revolutionary. Because you've made a charitable commitment, the IRS gives you an immediate tax deduction based on the calculated remainder value that will eventually go to charity. This deduction can be substantial, often 20% to 40% of the asset value you contributed. You're essentially getting a massive tax break for setting up an income stream that pays you for the rest of your life. But the evolution doesn't stop there. Modern estate planners combine the charitable remainder trust with life insurance strategies. You use a portion of your annual income from the trust to purchase life insurance that replaces the asset value for your heirs. This way, your children receive the full inheritance value through life insurance proceeds, while you've eliminated capital gains taxes, received major income tax deductions, and created lifetime income. Let me share a real transformation that illustrates this perfectly. Robert and Linda owned stock they'd purchased for $100,020 years ago. It was now worth $800,000, but they were afraid to sell because of the massive capital gains tax bill, about $140,000 in federal and state taxes. They needed income for retirement, but felt trapped by the tax consequences of accessing their wealth. We established a charitable remainder trust and transferred the stock into it. The trust sold the stock immediately without paying any capital gains taxes, then invested the full $800,000 in a diversified portfolio. At a 6% payout rate, Robert and Linda began receiving $48,000 annually for life income they could never have generated from their original $100,000 investment. The immediate tax benefits were stunning. They received a charitable deduction of $320,000, which saved them $96,000 in income taxes over 3 years. They had turned a static, highly taxed asset into an income-producing machine, while eliminating capital gains exposure and generating enormous tax savings. But here's the sophistication that modern planning adds. Robert and Linda used $15,000 of their annual trust income to purchase an $800,000 life insurance policy in an irrevocable trust. When they pass away, their children will receive the full $800,000 in life insurance proceeds tax-free, while the charity receives whatever remains in the charitable remainder trust. Their heirs end up with the same inheritance value, but Robert and Linda enjoyed decades of income and tax benefits they never could have achieved by simply holding the original stock. The numbers become even more compelling with larger estates. A family with $2 million in appreciated assets can establish a charitable remainder trust that generates $120,000 in annual income, while providing immediate tax deductions of $600,000 or more. The life insurance replacement strategy ensures their heirs don't lose inheritance value, while the parents enjoy financial security and enormous tax advantages. The critical action step is understanding the asset requirements. Charitable remainder trusts work best with appreciated assets worth at least $500,000, though $1 million or more creates the most dramatic benefits. You need to work with an estate planning attorney who specializes in charitable trust structures, because the documentation must be precise to qualify for tax benefit. But timing can be everything. If you have highly appreciated assets and you're approaching retirement, establishing a charitable remainder trust before year-end can provide immediate tax deductions that dramatically reduce your current tax bill, while setting up lifetime income starting as early as next year. The evolution from simple charitable giving to sophisticated trust strategies represents one of the most powerful shifts in modern estate planning. Instead of choosing between keeping your wealth and supporting charity, you can now do both while creating better financial outcomes than you could achieve through traditional investment approaches. while the charitable remainder trust creates income from appreciated assets. There's another sophisticated strategy that specifically targets the biggest tax trap most families face: the taxation of life insurance proceeds. This next approach has saved families hundreds of thousands of dollars by removing insurance from estate tax exposure entirely. Strategy number 3, the Life Insurance Estate Tax Elimination Trust. I'll never forget the day Sarah walked into my office holding her late husband's life insurance policy, her hands shaking with a mixture of grief and disbelief. The $2 million policy was supposed to provide security for her family's future. Instead, she just learned it was going to create an $800,000 estate tax bill that would force her to sell the family business her husband had spent 30 years building. This is the devastating reality most families never see coming. They buy life insurance thinking they're protecting their loved ones, not realizing they're actually creating a massive tax time bomb. The cruel irony is that the bigger your life insurance policy, the bigger the tax explosion it creates in your estate. But here's what validates every suspicion you've ever had about the financial system being rigged against regular families. There's a completely legal way to eliminate this tax trap, and most insurance agents never mention it because it doesn't generate ongoing commissions. The problem starts with a fundamental misunderstanding about life insurance taxation. Most people think life insurance proceeds are tax-free, and technically, they're right. The beneficiary doesn't pay income tax on insurance proceeds. But what insurance salespeople conveniently forget to mention is that if you own the policy when you die, the entire death benefit gets included in your taxable estate for federal estate tax purposes. Here's how this financial nightmare unfolds. Let's say you're worth $3 million and you own a $2 million life insurance policy. You think you're leaving your family $5 million, but the IRS sees a $5 million estate, which pushes you well into estate tax territory. At a 40% tax rate, your family suddenly owes $2 million in estate taxes. The very insurance policy you purchased to provide security has actually created a financial catastrophe. This is where the Irrevocable Life Insurance Trust, or ILIT, becomes your financial superhero. The legal principle is elegantly simple. If you don't own the life insurance policy when you die, it doesn't count as part of your taxable estate. An ILIT is a specialized trust that owns your life insurance policy instead of you personally owning it. When you pass away, the insurance proceeds go to the trust, not to your estate, which means they're completely invisible to estate tax calculations. But here's where most people get confused about the mechanics. You can't just transfer an existing life insurance policy to an ILIT and think you've solved the problem. The IRS has something called the 3-year rule. If you transfer a policy to an ILIT and die within 3 years, they'll still include it in your estate. That's why the most effective ILIT strategies involve having the trust purchase a new life insurance policy from the beginning. The case law supporting this strategy is rock solid. In the landmark case of Estate of Hedrick v. Commissioner, the tax court ruled that life insurance proceeds paid to a properly structured ILIT were completely excluded from estate tax calculations, even though the deceased had been paying the premiums through annual gifts to the trust. This established the legal precedent that has protected millions of dollars in life insurance proceeds from estate taxation. Let me show you exactly how this protection saved one of my clients from financial devastation. James owned a successful manufacturing business worth $4 million and had a $3 million life insurance policy to provide liquidity for estate taxes and family security. Without planning, his estate would have been worth $7 million, creating an estate tax bill of approximately $2.8 million. We established an ILIT and had the trust purchase a new $3 million life insurance policy on James's life. James made annual gifts to the trust to cover the premium payments, using his annual exclusion to avoid gift tax consequences. When James passed away 5 years later, the $3 million insurance proceeds went directly to the ILIT, completely bypassing his taxable estate. The results were transformative. Instead of a $7 million taxable estate, James's estate was valued at $4 million, which fell below the federal estate tax exemption at that time. His family owed zero estate taxes and still received the full $3 million in life insurance proceeds through the trust. The ILIT strategy didn't just save them $1.2 million in estate taxes, it preserved the entire value of the business for the family's future. But ILITs provide benefits beyond just estate tax elimination. The trust structure also protects the insurance proceeds from your beneficiaries' potential creditors, divorce settlements, and financial mistakes. If your children face lawsuits or divorce proceedings, the insurance money in the ILIT remains completely protected because they don't legally own it. The sophistication of modern ILIT planning goes even further. You can structure the trust to provide income to your spouse for life, then distribute principal to children and grandchildren according to your specific wishes. Some families use ILIT distributions to fund education expenses, business opportunities, or other family goals while maintaining complete estate tax protection. The practical application requires precise legal documentation. You need an estate planning attorney experienced with ILIT structures to draft the trust documents, establish proper premium payment procedures, and ensure compliance with IRS requirements. The trust must have independent trustees who have actual authority over the policy, and all premium payments must be properly documented as gifts to the trust. The timing consideration is crucial. If you already own significant life insurance, you need to evaluate whether transferring existing policies or purchasing new coverage through an ILIT makes more sense. The 3-year rule means new policies provide immediate protection, while transferred policies require you to survive 3 years for full estate tax benefits. For families with substantial life insurance coverage, typically $1 million or more, an ILIT can save hundreds of thousands in estate taxes while preserving the insurance proceeds for family security. The cost of establishing the trust is usually less than $5,000, making it one of the most cost-effective estate tax strategies available. The validation here is profound. If you've ever wondered why wealthy families seem to pay fewer taxes despite having more assets, this is exactly the kind of legal strategy they use. ILITs prove that with proper planning, you can have significant life insurance protection for your family without creating devastating estate tax consequences. What makes this even more powerful is how ILITs can be combined with other advanced strategies. While the insurance trust protects your policy proceeds, there are sophisticated business and investment structures that can dramatically reduce the taxable value of other assets in your estate. Strategy number 2, the family wealth transfer discount machine. Here's a fact that will shock you about how global wealth actually moves between generations. In Singapore, families routinely transfer business assets to the next generation at 30% to 40% discounts from full market value, and it's completely legal under their tax system. In Germany, family business transfers receive similar valuation benefits when structured properly. What most American families don't realize is that we have access to an even more powerful version of this strategy right here in the United States. It's called a family limited partnership, and it's the ultimate wealth transfer discount machine. This puts you back in complete control of your family's financial destiny. Instead of being forced to transfer assets at full value and pay maximum estate taxes, you can legally engineer substantial valuation discounts that dramatically reduce your estate tax exposure while maintaining control over your wealth during your lifetime. This is the strategy that separates families who build generational wealth from families who lose everything to taxes. The Family Limited Partnership, or FLP, works by creating a business entity that holds your investments, real estate, or other assets. You become the general partner with complete control over the entity's management and decisions. Then you give limited partnership interests to your children or grandchildren as gifts. Here's where the magic happened. Because the limited partners have no control over the assets and their interests are not easily marketable, the IRS allows you to apply significant valuation discounts when determining the gift value. Think of it as transforming your assets from individual diamonds into shares of a diamond mine, An individual diamond has clear, marketable value, but a minority share in a diamond mine that you can't control and can't easily sell. That's worth substantially less than its proportional share of the mine's total value, even though the underlying assets are identical. The legal foundation for these discounts comes from decades of tax court decisions, recognizing that minority interests in family entities are inherently less valuable than controlling interests. The courts have consistently approved discounts ranging from 20% to 50% for properly structured family partnerships, depending on the specific restrictions and the type of assets involved. Let me show you how this creates incredible wealth transfer leverage. Suppose you own $3 million in investment securities and real estate. If you gift these assets directly to your children, you're making gifts at full $3 million value, which will use up most of your lifetime gift tax exemption. But if you first transfer these assets to a family limited partnership, and then gift limited partnership interests to your children, you might only be making gifts valued at $1.8 million after applying legitimate valuation discounts. This means you can transfer 50% more wealth to your children while using the same amount of your gift tax exemption. Alternatively, you can transfer the same amount of wealth while using 40% less of your exemption, preserving more of your lifetime exemption for future gifts or estate tax protection. The comparison studies are remarkable. The American College of Trust and Estate Counsel analyzed over 200 family limited partnership cases decided by the tax court between 2010 and 2020. Properly structured FLPs achieved average valuation discounts of 35%, with some reaching 45% for closely held business interests. The families using these strategies transferred an average of $2.1 million more wealth to the next generation, compared to families making direct gifts of the same underlying assets. But here's what makes FLPs even more powerful for maintaining family control. As the general partner, you retain complete authority over investment decisions, distributions, and management of the partnership assets. You can continue to receive income from the partnership, make decisions about buying and selling investments, and maintain the same level of control you had when you owned the assets personally. The strategy becomes even more sophisticated when you combine it with systematic gifting programs. Instead of making one large gift of partnership interests, you can gift small percentages each year, maximizing your annual exclusions while gradually transferring wealth at discounted values. A married couple can gift up to $34,000 in partnership interest annually to each child without using any lifetime exemption. But the actual asset value being transferred might be $50,000 or more after accounting for valuation discounts. I worked with a family who owned a $5 million commercial real estate portfolio and a successful family business worth $3 million. Direct gifts of these assets would have required using their entire lifetime gift tax exemption of $12 million. Instead, we established two family limited partnerships, one for the real estate and one for the business interests. The real estate partnership achieved a 30% valuation discount due to the illiquid nature of the properties and lack of control for limited partners. The business partnership received a 40% discount because of additional restrictions on transfer and the specialized nature of the business. This allowed the family to transfer the equivalent of $8 million in underlying asset value while only using $4.8 million of their gift tax exemption. The transformation in their estate planning was dramatic. Instead of facing estate taxes on $8 million of business and real estate assets, the parents' estates would only include their retained general partnership interests, worth about $1.6 million. The strategy removed $6.4 million from estate tax exposure while preserving family control and providing ongoing income to the parents. But FLPs require sophisticated planning to achieve maximum benefits and avoid IRS challenges. The partnership must be established for legitimate business purposes, not just tax avoidance. The family must follow proper business formalities, including regular meetings, separate bank accounts, and detailed record keeping. Most importantly, the parents cannot retain too many benefits from the transferred assets, or the IRS might challenge the validity of the discounts. The professional guidance is essential. You need attorneys who specialize in family partnership structures and understand the evolving case law around valuation discounts. The costs typically range from $10,000 to $25,000 for proper documentation and setup, but families with assets worth $2 million or more often save 10 to 20 times that amount in estate taxes. The timing considerations are crucial for maximum effectiveness. FLPs work best when established during periods of low asset valuations because you're transferring larger proportional interests in the underlying wealth. If your business or real estate is currently undervalued due to market conditions, this creates an optimal opportunity to transfer maximum wealth at minimum gift tax cost. This is the financial empowerment that comes from understanding how sophisticated families actually preserve wealth across generations. While the government wants to tax asset transfers at full value, properly structured family-limited partnerships give you legal tools to transfer wealth at substantial discounts while maintaining control and generating ongoing income. The power of combining valuation discounts with systematic gifting creates wealth transfer leverage that can save millions in estate taxes over time. But as sophisticated as family-limited partnerships are, they're still just the foundation for the most powerful estate tax elimination strategy available to American families. That brings us to the ultimate wealth protection document, the one that can eliminate estate taxes not just for your children, but for your grandchildren, great-grandchildren, and beyond. This is the strategy that allows wealthy families to create financial dynasties that grow tax-free for over a century. Now it's time to reveal the ultimate estate tax elimination weapon that wealthy families have been using for over a century to build financial dynasties that last forever. Strategy number 1. The Dynasty Trust, your family's financial immortality machine. This is the document that can eliminate estate taxes not just for your children, but for your grandchildren, great-grandchildren, and every generation of your family for the next 100 years or more. It's called a generation-skipping trust, also known as a dynasty trust, and it's the closest thing to financial immortality that exists in American law. Here's how this legal masterpiece works. Instead of transferring wealth directly to your children where it gets taxed again when they die, you transfer assets into a dynasty trust that benefits multiple generations simultaneously. The trust pays income and distributions to your children during their lifetimes, then continues paying your grandchildren, then their children, and so on. Because the assets never actually pass from one generation to the next through individual estates, they never trigger estate taxes at each generational transfer. Think about the mathematical power of this approach. A traditional inheritance gets hit with estate taxes every 25 to 30 years as it passes from parents to children to grandchildren. But a dynasty trust allows wealth to grow and compound tax-free across multiple generations, creating exponential wealth accumulation that would be impossible under normal tax rules. The proof is in the numbers. A $2 million dynasty trust growing at 6% annually could be worth over $32 million after 100 years, with zero estate taxes paid during that entire century. That same $2 million passing through traditional inheritances would face estate taxes every generation, leaving the family with less than $8 million after the same time period. The Dynasty Trust creates 4 times more wealth for your family by eliminating the government's generational tax grab. This is the strategy that created the great American fortunes you read about in history books, and it's completely available to any family with the knowledge to implement it correctly. So let's take a step back and realize what just happened here. When we started this journey together, you were facing a financial nightmare. The government positioned to grab 30 to 50% of everything you've worked for your entire life. You were up against an IRS machine designed to extract $47 billion annually from families just like yours. You were fighting financial predators who profit from your lack of knowledge about legal wealth protection strategies. But you are not powerless anymore. You now have an arsenal of 5 legal weapons that can completely transform your family's financial future. You have the annual exclusion gift documentation system for systematic wealth transfer. You have the charitable remainder trust for turning charitable intentions into lifetime income and massive tax deductions. You have the irrevocable life insurance trust for eliminating estate taxes on your insurance proceeds. You have the family limited partnership for transferring assets at substantial valuation discounts while maintaining control. And you have the dynasty trust for creating multi-generational wealth that grows tax-free for over a century. These aren't just strategies, they're your financial freedom fighters. They're the same tools that wealthy families have used for decades to keep their money away from government taxation, while building generational wealth that lasts forever. Now I want to hear from you, and this is important. Which of these 5 strategies surprised you the most? What's your biggest fear about leaving your family with a devastating tax burden instead of the financial security you intended? Do you have your own story about watching families lose everything to estate taxes because they didn't know these strategies existed? Drop your experience in the comments below. I read every single one, and your story could be the protection someone else desperately needs to hear. And if you found these 5 documents as powerful as I know you did, you absolutely need to hit that subscribe button right now. Every single week, I release new videos packed with legal strategies to help you protect your wealth, maintain your financial independence, and enjoy your retirement without the fear of government confiscation. This channel is your ongoing education in wealth protection that most people never learn until it's too late. And speaking of strategies, you need to know, next week I'm revealing the 3 legal loopholes that can make your entire estate completely tax-free, even if you're worth millions. These are advanced techniques that the ultra-wealthy use that most people have never heard of, and they could completely change how you think about estate planning. Remember, you are only one smart decision away from complete financial protection.